Welcome to The Explainer. Today, we're unpacking what is easily one of the most fascinating and, frankly, polarizing stories in the market right now. We're looking at a company sitting right at the physical intersection of the massive artificial intelligence boom, Penguin Solutions. There is a totally explosive debate happening out there right now. On one hand, you have quantitative valuation models screaming that this stock has flown way too close to the sun. On the other hand, you have Wall Street analysts who look at this and say, nope, the enterprise AI wave, it's literally just getting started. So we're going to look objectively at their financial performance, the underlying technology they actually build, and try to make sense of this wild valuation divide.
But before we even get into what they do or how they got here, I just want you to take a second and look at this number, 242.43%. That is the staggering one-year total shareholder return for this stock. I mean, for investors who got in early, the whole AI hype cycle has translated into very real, very substantial realized gains. But, a climb that steep always forces a pretty critical question. Is there actually any upside left here, or are we staring right at the peak?
Okay, let's dive into our roadmap. We'll cover 1. The AI stock surge. 2. Powering the AI factory. 3. The bear case, overvalued. 4. The bull case, analyst upgrades. And finally, 5. Navigating the valuation divide.
Starting off with Section 1, the AI stock surge, rebranding, and momentum.
Now, if the name Penguin Solutions sounds kind of new to you, that's entirely by design. It's the result of a very strategic recent rebrand. In the past, they were actually known as Smart Global Holdings. They shifted their identity over to Penguin Solutions to better highlight their core focus on advanced computing and AI infrastructure. But make no mistake, this is not some scrappy startup we're talking about. They are operating from a massive foundation. We're talking about a $3.41 billion market cap and roughly $1.35 billion in revenue. So they have a very established, very real footprint.
And that rebrand, well, it's been accompanied by some undeniable share price momentum. Look at this trajectory. We've seen a one-day spike of over 12%, a 30-day return of 26%, and like we just talked about, that massive one-year return topping 242%. Even if you zoom out to a 5-year window, you're looking at a 190% return. The major takeaway here is that market enthusiasm for their role in AI infrastructure has already yielded massive gains across basically every time frame. The momentum is just historically undeniable.
Moving right along to Section 2, Powering the AI Factory, the reality behind the hype.
To really understand this valuation debate, we have to pull back from the ticker symbol and look at the physical technology. What is actually generating that $1.35 billion in revenue? Well, they aren't just boxing up generic servers. Their operations break down into advanced computing systems, integrated memory, and optimized LED segments. But the real crown jewel, the thing driving the whole narrative right now, is their turnkey AI and high-performance computing data center infrastructure. They essentially act as the architects and builders of the AI factory. As their leadership likes to point out, setting up AI can cost 10 to 20 times the price of a standard server deployment, and the learning curve is incredibly steep. Penguin's core value proposition is that they handle the whole shebang: design, build, deployment, and management, so enterprises just don't have to worry about it.
And the physical challenges of building these AI factories? They are absolutely immense. Listen to this insight from Penguin Solutions CTO Phil Picorni. He notes, the typical data center uses 120-volt power, but this isn't enough for an HPC rack. Companies need to plan for upgrades to 240 or 277-volt. Think about it. Artificial intelligence demands huge amounts of power, which then creates staggering amounts of heat. Managing that power draw, wrangling that thermal output, and ensuring thousands of GPUs run perfectly together, it's like a giant, high-stakes puzzle. And that is exactly the puzzle Penguin is solving.
Let's ground all this abstract tech in a concrete example. Take a look at Shell's IT data center down in Houston. Shell desperately needed to boost their high-performance computing capabilities, but they also had a mandate to push toward net zero emissions. So they deployed this absolute monster of a cluster: 864 dual-socket systems, over 1,700 AMD processors, and nearly 166,000 cores. To handle all the insane heat that generates without totally blowing their energy budget, they use Penguin's immersion-ready systems. The servers are literally submerged in cooling fluids. It is such a perfect illustration of how Penguin integrates heavy-duty hardware with advanced cooling to make AI physically sustainable for massive global enterprises.
Okay, shifting gears to Section 3, the bear case. Overvalued? Examining the risks.
Here is where the drama really starts.
We are seeing a stark, undeniable contrast right now. On one side, you have a recent trading price hovering up around $67.15. But on the exact opposite side, you have an estimated fair value of just $38.29, according to quantitative analysis from Simply Wall Street. That model suggests the stock could be roughly 75% overvalued. This right here is the absolute core of the bear narrative. The skeptics argue that the market, totally swept up in AI frenzy, has pumped the stock way beyond its intrinsic fundamental value.
So what's actually underpinning that massive valuation gap? Why all the skepticism? Well, the quantitative models point out that justifying this $67 price tag requires assuming some incredibly brisk continuous earnings expansion and richer, fatter margins going forward. If everything goes flawlessly, sure, maybe the price makes sense. But the bears are throwing red flags at some very real risks. What happens if there are delays in closing these massive, highly complex AI deals? Or what if macroeconomic factors, say tariff pressures on their optimized LED segment, start eating into the bottom line? Any of those things could squeeze expected margins, and if those margins shrink even a little, that sky-high valuation becomes almost impossible to justify.
But let's flip the script. Section 4, the bull case, analyst upgrades, enterprise AI adoption. You see, quantitative algorithms are really only half the story here. When you look at the actual human analysts covering the stock, the folks talking directly to management and scrutinizing the sales pipeline, a completely different picture emerges. Look at this market beat consensus data from 10 analysts. We've got 6 buy ratings, 4 hold ratings, and, this is the kicker, absolutely 0 sell ratings. None. 0. Despite the high trading price and all those loud warnings from the algorithmic models, the institutional consensus remains firmly at a moderate buy.
And this brilliantly illustrates just how deep the divide in market expectations really is. Look at the spread of Wall Street price targets over the last year. You've got a low target sitting all the way down at $24, which pulls the average target down to around $36.88, which, lines up pretty well with those bearish quantitative models. But then you look at the high targets reaching all the way up to $66, right up near the current trading price. It shows that while some analysts are definitely playing it cautious, others are looking at this and seeing massive sustained upside.
And honestly, the momentum among those bulls is only pointing upward. We've seen some very significant recent analyst boosts. Firms like Stifel Nicolaus just upgraded their target to $66, and Rosenblatt Securities boosted theirs up to $65. The logic here is pretty straightforward. The adoption of AI and high-performance computing across major enterprise sectors, from big banks to biotech, is accelerating wildly. The bulls argue that this incredibly robust demand is creating a fat, diversified pipeline of customer bookings that will easily support sustained revenue growth. Which brings us to our final section, Section 5. Navigating the valuation divide, making sense of the spread.
So the absolutely crucial point here is understanding what exactly the market is trying to value. It all boils down to this concept: turnkey compute infrastructure. Remember, Penguin isn't just shipping pallets of raw computer parts. They are delivering full, end-to-end solutions, blending hardware, software, memory, and that specialized cooling we talked about with Shell, all to rapidly deploy enterprise AI. Your belief in the unique value of that integration is ultimately what separates the bulls from the bears here. The bears look at them and just see a hardware company that's totally susceptible to margin squeezes. But the bulls? They see an irreplaceable architect of the AI future, an absolute necessity for companies that just don't have the internal chops to build these insanely complex systems themselves.
Which leaves us with one final provocative thought for you to chew on. You've seen that staggering 242% return, you understand the mind-bending complexity of the immersion-cooled data centers they're building, and you've seen the stark, divisive gap between the $38 fair value models and the $66 Wall Street targets. So as enterprise AI moves out of the exploration phase and into massive real-world physical deployment, you have to ask yourself, is Penguin Solutions' AI momentum already completely priced into the stock, or is their AI factory literally just powering up? It is a truly fascinating market debate, and for sure one we are going to continue watching very closely. Thanks so much for joining us for this explainer.